Understanding the key differences between these two types of loans can allow you to make a knowledgeable decision about which one to use. Hello and welcome to Practical Personal Finance, where you get the information you need to understand and succeed with money. In the next few minutes, I'm going to help you understand the similarities and differences between secured and unsecured loans. The differences will be broken down into 4 categories: collateral, interest rate, loan amount, and approval odds. Finally, at the very end of this video, I'll give you my advice on how to decide which type of loan is right for your unique situation. Let's start off with some similarities. Both secured and unsecured loans involve borrowing a specific amount of money from a bank, a credit union, or an online lender, and paying that money back over a specific period of time, otherwise known as the loan term. Both types of loans will involve paying some interest fees for the privilege of borrowing money, in addition to repaying the principal or original amount you borrowed. And in both cases, the interest rate you're assigned will largely depend on your credit score. If you have a high credit score, you'll be assigned a lower interest rate. But if you have a low credit score, you'll be assigned a higher interest rate. And as a result, you'll end up paying more in interest fees over the life of the loan. The biggest and most important difference between secured and unsecured loans has to do with something called collateral. If there's one thing I hope you take away from watching this video, this is it. A secured loan is backed by collateral, while an unsecured loan is not backed by collateral. Collateral is something that you own, some sort of asset that you're offering up as a means of guaranteeing the loan. Basically, you're telling your lender up front, if I don't repay this loan according to the repayment schedule we agreed upon, you have the right to take possession of my asset and sell it in order to get your money back. Some examples of collateral might be your home, your car, or your stock portfolio. On the flip side, unsecured loans do not have any collateral attached to them. Your lender is letting you borrow money based only on the fact that you've agreed to repay it over time. If you fail to pay, there's no asset for them to take possession of and sell. Their only recourse is to file a lawsuit against you for what they're owed. This makes unsecured loans a lot more risky than secured loans, which will be important to remember when we're looking at the remaining differences. Before we tackle those, if you're getting some value out of this video so far, give me a thumbs up down below. Thanks. The second difference I'd like to highlight between secured and unsecured loans is the interest rate. Secured loans tend to have a lower interest rate than unsecured loans. This is because secured loans have that collateral attached to the deal, making them inherently less risky for lenders. After all, as I mentioned a minute ago, if you don't pay, they can just take your stuff and sell it in order to get their money back. Furthermore, because you've got something to lose, lenders know you'll be extra motivated to make your payments on time and in full. With no collateral involved, unsecured loans are somewhat riskier, but the promise of more money paid in interest fees makes unsecured loans worth it for lenders. The next difference involves the amount you can borrow with each type of loan. With a secured loan, you can typically borrow a lot more money than with an unsecured loan. This again ties back to the collateral. In the case of taking out a loan to purchase a home, you're able to borrow several $100,000 because the home you're purchasing is the collateral. Yes, it's risky to loan someone several $100,000, but if you default or fail to pay that loan back, they can always take possession of the home through the foreclosure process and sell it to make their money back. With an unsecured loan, they can't do that, so the amount that lenders are willing to let you borrow will be smaller. The final difference I'd like to mention has to do with your odds for approval. It's somewhat easier to be approved for a secured loan than for an unsecured loan. Once again, this has to do with the amount of risk associated with each type of loan. With an unsecured loan, the risk is higher, so the lender is going to be more careful about who they're lending money to. If you've got an excellent credit score and a low debt-to-income ratio, you'll probably get approved for either type of loan without much trouble. But not everyone falls into that ideal borrower category. Maybe you've got a credit score in the high 600s with a fair amount of debt obligations. The odds of you getting approved for a secured loan, where there's less risk involved for the lender, are greater than the odds of you getting approved for an unsecured loan. If you're thinking about buying something really expensive, like a home or a vehicle, then you'll probably be using a secured loan to do it. A mortgage is a secured loan with your home as the collateral. An auto loan is a secured loan with the vehicle as the collateral. Boat and RV loans follow a similar pattern. If you're a homeowner, you may be able to use the equity in your home to obtain a home equity line of credit, or HELOC, which is essentially a secured loan that can be used for a wide variety of purposes. The collateral with a HELOC, as you might have guessed, is your home. Unsecured loans are typically used to pay for school, a wedding, or a dream vacation. If you have a bunch of credit card debt, you can consolidate it with an unsecured loan, and you'll probably save a bunch of money on interest in the process. No matter which type of loan you're looking at getting, it's important to shop around, keeping in mind that the lowest interest rates tend to be found with credit unions and online lenders. And before you sign on the dotted line, make sure you have a complete understanding of what you're getting yourself into. Not just whether or not you can manage to make the monthly payments, but more importantly, whether or not this loan moves you closer to your future financial goals. Do you have any other questions about loans? I'd love to answer them, so let me know in the comments. If you enjoyed this video, you might like this other video where I do a full comparison of checking and savings accounts. Click right here to watch. And if you're not yet a PPF subscriber, click right here to hop on board. As always, thanks for watching. I'm Andrew Shear, and I'll see you next time.